of Real Talk, where we put the real in real estate, and we've got the real deal, our friend Britt from Fair Texas Title, to talk about Chicken Little. Is the sky falling? What does that look like? Do we need a helmet? Do we need a bomb shelter? Is there going to be sunshine on the other side? So, Britt, thanks for joining us as usual.
Thank you for having me. I feel maybe I should be having my Chicken Little helmet on or something, you know?
Right.
Especially when Parker titled this, you and Parker titled this "Unpacking the Recession Forecast." Like, you know, it's you threw the R word out there.
He did. I think some of that was after our conversation the other day. You know, you got to throw some marketing clickbait in there, but we're not going to be we're not the bait and switch. There are things that obviously are indicators, and we have to be having credible conversations because, as you said too, our industry really likes to sell things positively, and that's what sales is. But we also have to package it with realistic expectations. And as I said on the pre-show, I think the word is endure this year and going into next year. And there's different things we can do to set ourselves up for success. But I think first off, why don't we just kind of give a real high level, you know, a kind of 30,000 foot, what's going on right now as we see it through, you know, I mean, we're almost through the third quarter of 2023.
Yeah. Well, I think anytime you're talking about now, you got to first start with COVID, right? Because you build this, you know, when COVID hit and after we kind of, you know, waited a month or so, like everybody started going gangbusters. You know, money was, the government was throwing money out in whether it was Congress or the Fed or whatever, but like there was money aplenty and people got the memo to buy real estate, right? So we, starting in mid 2020 for about 2 years, for maybe about 24 months through mid 2022, we were setting all kinds of records, right? Of volume of transactions and interest rates. Mortgage rates were super low. You know, a lot of people buying in that 3% range. People refinancing in that 3% range as well. So what has happened since then is, you know, and again, there's a whole lot of blame to go around, but the Fed they came to the realization that inflation was not going away on its own. Inflation got out of control. So they raised the Fed funds rate and because of the inflation expectations and the Fed funds rate going up, mortgage rates went up pretty dramatically. So we went from the 2 something, you know, upper 2s to, what did I read? It was 7.5 today on the 30-year, or 7.49, I think, according to Mortgage News Daily. So what that has done is clearly put a chill in the market. And, you know, everybody originally, I mean, at least until a few months ago, everybody was talking about buyer affordability, and with reason, because prices haven't really come down and payments have gone up because of the mortgage rates. But I think only in the last few months have people caught on that the real issue is with sellers or the lack of sellers. And basically that sellers are wanting to hold on to their property because they love their 3% mortgage rate, right? And they want to hug it. I'm not letting
stroke it.
And so, you know, some people who might actually be otherwise want to be sellers, you know, they might want to upsize or downsize or move across town or whatever, but they're saying, yeah, I like my 3% mortgage and I don't want to, even though I want to trade to a different house, I don't want to lose this 3% mortgage. So I'll just stay here and endure where I am. So from a title perspective, from a realtor perspective, certainly from a mortgage perspective, everybody is dealing with slowness and a whole lot less activity, a whole lot fewer transactions than what we got used to in that 2-year craziness period. And so, you know, you combine the what feels like a slow market with now it's sort of that end of the summer selling season, right? And so just seasonally, things typically slow down a little bit as you go into the fall. And so right now it feels pretty slow.
Well, and it does feel like Satan's lair outside as well.
That might be part of it.
that doesn't make it real fun to want to get in a car and go pound the pavement. And school started earlier for most people, except your daughter. So it was her first day of school.
Yes.
Yeah.
Hey, as long as we get them on the path.
Yeah, but I mean, a lot of the school districts started 2 weeks ago, so now you're getting into a rhythm. It's hot. Interest rates are at a an all-time high for us in the last several years. So there's a lot of things going on. Something that you touched on was as far as the 3%, but the other part of that is with sellers is the amount of equity they have in their properties as well, whether it's from recent years or just holding for long term. Saw a statistic where 42% of nation's homeowners don't have a mortgage. And so
that is wild.
when you're talking about 42, and that came from Real Trends Housing Wire. They just put on a really great conference a couple of months ago. And so, I mean, data analytics is their thing over there. And so it was 42% don't have a mortgage. And then the other part is our equity pool in the United States is actually larger than China's GDP. And so those are some huge numbers. I mean, they're different type of numbers than we normally work with when we're talking about market updates here. But I do think it recalibrates some of the uncertainty or people kind of reverting back to Chicken Little Sky is falling, foreclosure, short sales, distressed properties, all of these other things. Well, when 42% own their homes outright, there can still be distress because they can no longer afford it because of taxes and insurance and maintenance costs. But they have enough equity to still sell, at market value.
Shoot, even the people who have mortgages, unless they've gotten their mortgage in the last 12 months, probably have enough equity to where even in a job loss situation or whatever, they shouldn't have to be foreclosed upon. They may be threatened with foreclosure, by their lender or something, but with the amount of equity that I think most homeowners do have, even in a situation, what causes foreclosures typically? Well, it's usually job loss or health issues, right? You get sick. And in both of those cases, somebody may have to sell their house to be able to pay bills and things like that. But I think they should be able to sell their house in this housing market pretty easily and still have the equity to walk away and move on with their life,
As Clinton just pointed out, plus real estate is regional. North Texas is well off in general. And I think, that's pretty Clinton. And I think I brought it up on one of our other Faircasts that we've done together on Real Talk. And it was, I'd love to see an approach. We do that on insurance, right? They forecast based on weather patterns and losses and everything else, but we don't do that on interest rates. As far as
or measurements of recessions. I mean, nobody, we can conceptually say that. I mean, I'm going to go out. I'll go ahead and say I am in the camp that says that we are approaching a recession in the United States. Okay. So, but that doesn't necessarily mean that North Texas is actually going to have a shrinking economy, which is basically what a recession is. That doesn't mean it happens everywhere to the same degree. So we could still be growing somewhat here, maybe slower than we otherwise were. But there could be a recession on a national basis. And you're right. Same thing, interest rates, mortgage rates are done nationally. We don't do them really, like, oh, in this little neighborhood, we're going to have this mortgage rate. It just doesn't really work.
No, we stack our appraisals that way based on whether or not you should lend appropriately on this. Right. And obviously that would take beyond an act of Congress, because I think we've seen Congress doesn't like to necessarily move the needle. But, those are the things that I think we can articulate on a local level, though, have very strategic conversations about what's going on. And so, yes, there's fear. There's always going to be fear. But going back to the early 2000s and seeing what led up into that treacherous, financial crash, there were a lot of factors. But as far as people losing their homes and the onslaught of foreclosures and short sales, there were a few years of a huge uptick in bankruptcies that were being had prior to that. And then you have, the financial industry crash, the stock market, the mortgage industry, everything else. And so people didn't have the equity. People didn't have anything, right. And so now,
but even there, the foreclosure differences between North Texas and, I'll pick on Phoenix or Las Vegas or some of these places. But I mean, these places where, that all the funny loan programs that, the ninja loans and the no doc loans and the liar loans and whatever we all called them. But, so, I mean, it's not uniform across the country, and those places were just decimated because, that's people were buying entire neighborhoods with basically bogus lending programs or whatever. And fortunately, we were fairly conservative on the lending practices in Texas, or at least relative to those other places. So we also came out unscathed, or not unscathed, but less hurt than a lot of other places. So our prices didn't really drop very much. Whereas, you were seeing 40% drops in places like Phoenix and Las Vegas.
Yeah, no, absolutely. And I think it's still hard. What I hear, if we're talking, regionally and locally and everything else, is that the average person that has lived in Texas or North Texas, for an exceptional part of their life is saying it's unaffordable. Well, yes, in relation to what it looked like even 10 years ago, it has exponentially grown. But I think it's also prudent to kind of compare that we are one of the fastest growing, metropolitan areas in the country. And if you compare us with some of the other top metropolitan areas, we are still considered one of the most affordable metro markets. That doesn't mean that it doesn't stink for our other residents and the people that have been here. And it is unaffordable for them to be still central. But I think that's where we're seeing that, I like to call it suburban rural. Where we're seeing it pushed into
the outskirts, the exurbs.
We went to NATCAR at one of their events, the North Texas Commercial Association here. And they had, the infrastructure, roads people, much smarter than I can't remember their titles, but they basically go from municipality to municipality and really help them chart this and what are your goals and what do we need to do and all these other things. And so they were looking at the patterns and what the growth's going to be over the next 20, 30, 40 years and making sure that our infrastructure, speaking more towards high-speed trains and other types of infrastructure that will allow continued affordability and decrease the compression that's going on our really, urban centric and central suburban areas. And it's just going to continue to push out. And so we're working towards affordability. It's just not exactly what everybody desires.
Well, I think, 20 years ago when I got in the real estate business, in the title business, that was one of the selling points of North Texas was that we were affordable. We were on the affordable end of the spectrum. We weren't the cheapest market, but for a growing metro area, we were on the affordable side of average, right? I think over the last 20 years, we've actually moved to the other side. I mean, to the less than affordable, if you had a kind of an average, but we're pretty still close to the middle part of affordability, to where compared to a lot of places, a lot of people still find us very attractive and affordable because, they're coming from the coast. So they're coming from, big, expensive city, Chicago, New York, LA, San Francisco, Seattle, whatever. So we don't have it's not necessarily a huge positive for us as far as relative affordability, but it's not to the extent that it's a negative now. We're kind of right there in the middle. We're certainly not the coastal expensive. I mean, those places have gotten, they were expensive 20 years ago, and they have also gotten more expensive over the last 20 years. So,
Harmon, diversity keeps it in flux. I mean, that's the other thing too, when we were talking the other day, and I don't know exactly if this is hitting the nail on the head, but diversification is key, whether it's diversification in product type. If we're talking about just housing, needs and affordability, we've got urban, we've got suburban, we've got, super rural, we've got that suburban rural market. And so we do have all of that, where some other metropolitan areas in the country don't have those.
Well, and business mix too. I mean, growing up here in the 80s, and the awful economy that we had in the back half of the 80s, everything was North Texas had like three primary industries, right? It was oil, and it was banking, finance, and it was real estate, and
Yeah.
they all crashed at the same time, right? And so it was
Yep.
like they were all tied in together. And fortunately, since that period of time, the North Texas area has really done a good job of diversifying. You know, I don't know if it was intentional or just it happened that way, but like, you know, Houston, as an example, like has stayed true to its roots of petrochemicals and oil and refining
Right.
and those kinds of things. And, you know, they've done well too, but they have a little bit more or a lot more boom and bust in their economy.
Yes.
Whereas, you know, we've gotten all the healthcare and the telecoms and the financial services and all these kinds of things that, you know, have really diversified. So I think it's, you know, I'm a big cheerleader for North Texas. I think you know that, and I know you are too. But it really is a healthier economy here than a lot of these places. You know, I mean, again, it's fun to pick on Houston, so I'll pick on them. But I mean, you know, San Francisco technology and .coms or whatever like that. That is not. That's not necessarily a cluster you want to be in, right? So
no, it's like Clinton. I mean, especially with oil. I mean,
West Texas,
boom and bust. You know,
yeah.
I mean, they've seen it's you get lean and mean or fat and happy. I mean, there's not really an in between, and it's like Brian Buffini. You know, you got your peaks and valleys, but you want to make your valleys a lot more manageable.
Yeah,
you know, that your floor is raised.
I feel like West Texas has had a pretty good run, but then I remember. I mean, it was maybe 3 years ago. Maybe it was during COVID when what was the price of a barrel of oil went to -30 or something, like for a very short period of time. It was like way down.
It was bad.
Yeah. It was like you had to pay them to take their oil, or, you know, or for them to take whatever. It was a negative.
No, you're absolutely correct. I methat's still, Texas is the number 2, if not sneaking into the number 1 state for net migration from across the country.
Yeah, and that's Florida. Was Florida the other one?
Yeah, Florida's number 1, but I think we're kind of getting closer to, you know, getting that margin closed. And it's just because the businesses still see the value in coming here because of the flexibility. You know, it's not to say that Florida's not fantastic, but North Texas, the diversification, going back to that, I had a client that moved from Indiana, and his big thing, he was like, it's actually cheaper in Indiana. I love my house. I'm taking my wife kicking and screaming. And, but at the same time, he said, I want options for myself and I want options for my children, because where he was coming from, he worked with one company, and that company was transferring him here for their distribution side and everything else. He said, but if I didn't work with them, you have one company, that company goes out of business, then I'm stuck. But here, I have options to not even do lateral movement, but I have upward mobility. Yeah. And I want that for my children to be cemented in North Texas in school age, so they too have that benefit of our economy and our diversification in the companies that are here. And I thought that was great, especially if I want my child to stay close to me. Other parents might not want to, but I want my child to have opportunities to be able to pursue her passion in the workforce, whatever that looks like. So,
and I think, you know, I mean, the reality is, you know, so like I said, we can talk all day about our love and admiration for what we've got going here, but I do want to hit on the challenge that I see right now. Just economic, you know, like obviously the government, this is not a shot at anybody politically. I think what we figured out by now is that all politicians seem to love their gig and want to do whatever they can to stay in office. So clearly the people who are in office are going to do their darndest to prevent a recession, right? I mean, I think they're, you know, now the Fed may not cooperate, and the Fed is not an elected position. So, but you know, the problem that I'm seeing is, and sort of reading the tea leaves a little bit, I think the consumer in the United States is tapped out. That's my sort of working hypothesis. And when I say that, I'm saying, you know, the credit card balances at the end of the second quarter were just announced that they're over $1 trillion for the first time, you know, and the chart is just going up, 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 up. And not only are the balances over $1 trillion, but they're paying over 20% on the $1 trillion. So that's a huge commitment for consumers. Meanwhile, we've had consumers who have had student loans on pause for whatever 3 years now, and there's at least a possibility that those are restarting in the fourth quarter. Now, who knows what government programs are going to come up to stop that or pause that further or whatever. But so student loans are, let's just say, restarting. There still have been a lot of municipalities, not necessarily in Texas, but where like there's been foreclosure moratoria, and so people have just not been paying rent and are only recently starting to pay rent again, or And so for all these things, and inflation. Did I mention inflation has sort of been taking a bite from people's
just a little bit.
So my fear or my belief is that there's one last thing that's also important. So I mentioned this earlier, but during the COVID era, there was this era of free money, and we had all these stimulus programs passed by Congress. They all had catchy names, the Inflation Reduction Act, which didn't have anything to do with inflation. It was all about subsidies for green energy and whatever. We had the infrastructure stuff. We had PPP loans. We have what's the one I get calls just about every day from spammers telling me employee retention credit. You can have $26,000 for every employee that you had on whatever. I mean, and it's like, so all these programs have been spitting money out into people's pockets. And, the studies that I've been seeing have been pointing to the fact that it appears that for the most part, most of this excess money, I call it excess savings, that has been going into people's pockets since COVID has reached that drying up point, for lack of a better word. And people already have now been dipping into the excess savings, and the excess savings now are gone or are expected to be gone by the end of the third quarter. So we're a month away.
Sure.
So for all those reasons, I have this theory that the consumer is tapped out. Okay. And so, what does that mean? Or what are the implications of that? Well, there was for example, this morning I was watching, the one of the stock show, CNBC, I think it was, and they were talking about Dick's Sporting Goods and Macy's reported their earnings and their guidance. And they both just tanked like 25% today. Their stocks did because it was so depressing as far as what they were saying. Like, just people have stopped buying, and not only that, but they have Macy's has its own credit card company, and people are late on their credit cards more so than they have been. And then they also both have like theft problems, which that's a story for different day.
Business models and some other things that are going on.
Yes, but anyway, so I'm just, that's what leads to recessions. Well, the consumer powers about 2/3 of the U.S. economy, and so if the consumer is pulling back, I have to imagine that, a recession, even a technically, however you define a recession, which we can argue about that one too, but I have to feel like that's right here on the doorstep here in the U.S.
Well, and I think, and we've had some really great commentary in here. We've got Harmon, who said after the 5-star conference next month, he'll have a better feel for defaults leading to foreclosure. Not familiar with that one, but seems like, that's something that will give some good indicators. There you go. Dallas, September 18th through the 21st. The other thing too, what all of this does is we're talking about regional economy and being hyper local. It also means client specific. And when we're talking to our clients, whether they be buyers or sellers, we really need to be very hyper vigilant and specific when we're talking to each one, because their needs are different. So to just say qualifying their budget, that's inappropriate, because really understanding what their goals are right now. Obviously, we try not to get into the financial side of things, but you have to understand when we do have all these contributing factors, student loans, credit card debt, and then on top of, I've never talked more about insurance and taxes in the last, few years, but specifically on insurance the last year, just having that conversation, that's more expensive. That I pay more in insurance across the board between health and home and auto and life. And, I'm sure my family has 92 policies on me that I don't know. No, I'm just kidding. So, but no, I mean, you have all of that kind of stuff. And those are conversations where, as realtors, it doesn't mean we didn't have conversations about insurance, but it is such a key contributing factor when you're talking about positioning your home as a seller, because now they're doing site inspections on all properties to consider insurability, vegetation, all of these other things. I've had numerous ones where I've had their insurance, actually their policy was terminated and they gave them a 30-day grace period to fix the issues after they moved in, because there were shrubs too close to the foundation in the house. There were trees that needed to be trimmed. Before, it was like, I'll get to it, that's something that I need to do. But now insurance carriers are saying enough, because they've paid out all these catastrophic claims. And so insurance is so expensive. We just got some property tax relief passed, but property taxes with the increased values is so huge. And so from the realtor side, from the realtor association side, guys, have really specific conversations, because there are all of these exterior things that we do not have control over. But I like to talk about what we do have control, and that's having these strategic conversations about setting realistic goals and expectations around interest rates, property taxes, and insurance.
Well, and like I said, we were kicking around this blanket term recession, and not everybody is impacted the same way. Clearly, I mentioned Macy's or Dick's Sporting Goods. That was today, but clearly they're probably going to announce, oh, we're going to have to cut some jobs, right? I mean, that's just kind of how corporate America works. Well, so if you have a Macy's employee as a potential client who gets laid off, clearly your conversation with that person is going to be one thing about, hey, we need to wait and rebuild and let you employed and all that kind of stuff. But the other thing is, I sound kind of negative about the economy as far as.
That's fine, bring it.
Well, no, but I mean, that's actually going to be what brings back the activity in North Texas in real estate. Yeah. And what I mean by that is the thing that has slowed down our market primarily is what we talked about earlier, this log jam between all these people holding on to their old rates. And now we're at almost 7.5 on the 30-year fixed. So if we have a recession, the silver lining to that cloud is that a recession tends to bring interest rates and mortgage rates down from the prevailing levels. And so, I don't know how deep a recession this is going to be. But the point being that it will be a recession or a slowdown in the economy, whatever you want to call it, that ultimately brings down inflation threat. And that will be the thing that also brings down our mortgage rates. And so once we get mortgage rates down to something that's closer to what people have on their existing homes, I think then people will be willing, if it's a 5, let's just say we somehow get to 5, and you can ask whether that's realistic or not. I mean, the Mortgage Bankers Association seems to think so, but other forecasters don't. But like whatever the number is, there's some number where people are willing to all of a sudden go, okay, I am willing to make the trade out of my 3% mortgage. I really want to move across town. And so I'll take the 5 or 5.5 or 6 or whatever it is. I wouldn't take 7.5, but so I think there's going to be some psychological number. And so I think that is the silver lining of this recession talk, is that it actually is going to help us on the interest rate standpoint. And so, when exactly that will happen, I don't know, but that will be the precipitating factor that brings the mortgage rates down to where it sort of unlocks this stalemated housing market that we have.
So let me do this, and this is not political in nature as far as responses. It's just more what obviously we've seen. We do have an election cycle that is coming up, in a pretty heated one, obviously nationally. Being that there are things that get strategically altered, I won't say manipulated, strategically altered during times of trying to be more popular, because I feel like we should have already been here. We've been talking about being in a recession for 18 months, 12 months, whatever that has been. And I think people have thought we would probably have moved that needle more towards a little bit of depression, and I'm not saying mental, I'm saying financial.
Yeah.
But if you do that, then it changes the tone and across the board. And so while we need it to be more of a depressive environment, that doesn't bode well sometimes when we have a heated election coming up. Do you think that we're actually going to go into the recession that we need? And I don't say it that we need it, because that's horrible to say, that people are going to get hurt to stabilize and bring the economy back up and bring the spending up, but that's naturally what has to happen.
Well, I think our industry is in a recession. But
correct.
If a recession means that it's slower than it used to be, than it was a year ago, well, then we're definitely in a housing recession, right? And you're right. Nobody, even in politics, nobody should be cheering for a recession, as far as,
no,
because that ends up being job losses and people get hurt, and there are some foreclosures, and there are so nobody wants that, and that's why I describe something as a potential silver lining. Well, the silver lining is like, okay, it's bad, but hey, at least this, right? So but yeah, like I said, I love to make fun of politicians of all parties, and and it's clear that incumbents want to not have a recession, right? Because when there's a recession, you point to the person who's in office, whether it's president or whether it's Senate or whether it's the House, and you say they were the one who was in power when all that bad stuff happened. Get them out, and so clearly they're going to do whatever they can. Now the thing is that I don't believe the House and the Senate will get on the same page on anything. I think it's very possible that we're going to have a government shutdown at the end of September, I believe it is, when the fiscal year ends. And, a lot of times they've just kind of glossed it over with one big omnibus bill that funds the government. And I have a feeling, the Republicans in the House are talking tough, saying that they're not going to do that. And so, I think it's unlikely that they can really pass anything anyway, as far as getting the House and Senate on the same page. So I think that the real question is, what will the Fed be doing? And right now the Fed, kind of the betting is that they're going to be just kind of neutral, not necessarily raising much further, but really not cutting rates at this point. There's a funny story. I may have told you this before, but so the problem in the 70s was that every time inflation seemed to be getting under control, the Fed took its foot off the brakes, right? And then inflation would rear its ugly head back up. And there was the Fed chair back then was a guy named Arthur Burns, and he's remembered as the guy who was consistently trying to, not doing his job, basically, and was taking his foot off the brakes. Mm-hmm. And and I think this is a real story, but apparently one of the new security guards at the Fed, where Jerome Powell works, when Jerome Powell was was sort of welcoming this new security guard, saying, well, I'm Chairman Powell. This is my office. And the security guard says, wait, is that you on that picture right there? And he said, yeah, it is. And he said, who's the guy in the picture next to you? And he said something like, well, that's one of the Fed chair from the 70s. That was Arthur Burns. And the guy goes, Burns. Is he the one that kept letting inflation rear its ugly head? Whatever. Like, that was the one thing, like the one Fed chair that the guy knew was the one who everybody was saying, you don't want to be like Arthur Burns. And so I think the reason I say that story is because I do think that Chairman Powell is very sensitive to not being Arthur Burns. And so I don't think that there is a rate cut coming in the near future, because I think everybody keeps saying, oh, you're a wimp, just like Arthur Burns. And he's going to say, oh yeah, I know I'm not, please stop saying that. And so I don't think that the Fed is going to take their foot off the gas, because I think he's terrified of being called Arthur Burns.
Well, Clinton says the same thing. Powell doesn't want that legacy. So we've got some really smart people that are sitting here. We got somebody on LinkedIn that says mortgage rates seem to mirror the inflation most of the time since the 1960s. So You
yeah,
know,
no, that
I
you
mean,
got to get inflation under control, and when inflation gets under control,
yeah,
rates get under control. I mean, that's
yeah,
that is exactly right. That it's not as much the Fed funds rate that determines the mortgage rates, but it is the expectation of inflation in the future that is the biggest driver. And so if we can get if Powell can convince people he's not Arthur Burns and he's not going to let
yep,
inflation get out of control, well, then people will say, oh, well, inflation is going to be under control in the
yeah,
future. And so then mortgage rates come down because of that expectation of inflation in the future. But I think that takes a while to come, like I said, so I don't think we're going to get much help to prevent the recession from the Fed either, because like I said, I think he's more concerned with the inflation legacy. So anyway, that's I don't think so to answer your question, that was a long way of answering that.
I love it.
I don't think the elected officials can get along to pass anything, and I don't think the Fed is going to intervene by cutting rates and saving the day from the recession, because like I said, inflation remains a problem, and I think it's actually about to sort of bottom and go on its way up again, just due to some mathematical reasons that so I think inflation is still an issue, and I don't think the Fed is going to be cutting rates and saving the economy anytime soon.
No, I would agree with that. Now, on a side note, I just came in and I popped on here at 5:25, coming in from an all-day MetroTech budget and finance meeting. And if there is a room full of individuals who are having a phenomenal time in a 200-page budget, we got through 140 pages, and you would be proud. So maybe we could teach our elected officials a thing or two how to cut the mustard through some of these expenditures. So you guys would be proud, MetroTech members, that we were able to keep things moving. And, I mean, there's forecasting across the industry that we have to be cognizant of. That doesn't mean that we have to cut ourselves off at the knees. But I think that's the biggest thing, especially with realtors. We haven't done ourselves any service on projecting when things were slowing down. And that's the thing. I mean, I think, what goes up does come down some. We had a comment, I think it was boom or bust or soaring and stable. And, that's the truth. And so sometimes you have to kind of pull back and be a little more conservative, because things have to shift and change. It doesn't continue to go up, 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 up. And I think just as an industry and as a whole, for me, I think we didn't do a good enough job as realtors right now, and people are hurting. And so part of this too, which is obviously not just forecasting what's going on with the economy, it's also giving some tools and some realistic expectations to our industry members, Britt, whether it's affiliate or realtors, is to really talk about how we can position ourselves. I think I said the word is endure. Guys, we are going to come out on the other side. It is going to pick back up. We have one of the strongest economies. We are one of the most, highly sought after metropolitan areas. All things are indicating our dance card will be full and popular again. It just isn't as full right now. And so I think we just need to be strategic. That doesn't mean abandon everything and go into this scarcity mindset, but I think we have to be realistic in how to position ourselves, and also what your projection is of how long do you think we kind of have to endure and this is just, I mean, you don't have a crystal ball, but I mean, you're a business owner too.
Yeah. I think, again, you are right. You have to be lean as you can. If you go into rough times, your fixed costs, you have to keep low. And, again, I'm not trying to contribute to job layoff talk and speculation, but you've seen it at mortgage companies. You've seen it at title companies. You've seen realtors kind of deciding that they had, they weren't selling enough homes to make it. They were deciding, they were cutting hair while also being a realtor and thinking it was easy because you just put a sign in a yard. And there are a lot of people in that business, that are realizing it's not that easy, and especially in a market like this. So it's gonna force everybody to look at themselves and look at their companies, and that's just the reality of economic decisions. How long will it last? Well, I mean, I think I mean, if I had to place a bet at this point, I'm betting it's not in the first half of 24.
I agree.
So I think it would be the back half of 24, sort of at the earliest, that we're going to start going, okay, rates, and like I said,
a year from now.
Yeah, but that requires that the economy be bad, right?
Yeah,
because like I said, in real estate, like I said, we're locked up with these people who won't sell their houses because they're holding their mortgage, and the only way you're going to get out of that is if rates get to a certain point, and that's, like I said, that's going to happen because it's a recession is driving it that way, and because one of the chat mentioned it's going to have to be Powell and that group holding firm to get inflation under control, and that drives us into a recession, but that also sort of brings down the inflation expectations, and that's whenever that happens, and like I said, let's call it late 24. I think that's when all of a sudden the activity picks up in North Texas real estate, because it will unlock those sellers.
So a wise old owl, Sherry Fearbacher, and I can say that even though I just said old, and she's probably going to school me later. That probably wasn't my.
You're in trouble.
Yeah, I'm in trouble. So my broker, business partner, and mother said, got to tell you both, you are too obviously well-informed, and this is great info. And if the past trends prove out, great, I feel better. But in reality, it's we the people. And for real estate, that starts with us, the professionals, been here, done that. And what you were saying that as she put that in the chat, and it's basically there are a lot of people that have gotten into our industry over the past few years because they thought it was a money grab, and it was. And so don't tell the people that I'm on budget and finance with at the association, because a lot of that contributes to membership count. But the part of it is just as a business owner and a practitioner, a third of our licensees in the state of Texas have been licensed for less than 3 years. And so from that standpoint, I'm just going to say some natural attrition is okay. And I know from an affiliate perspective too, there's a lot of people that have gotten into the title game and, other affiliate businesses, that they're realizing, oh, wow, I don't think we can do this. Let's figure out the next venture. And that is beneficial, because if you are a true and tried professional that is watching things like this and informing yourself and educating and setting realistic expectations for your clients, you're going to be okay. Yeah. You're just going to have to tighten things up. And the biggest thing that I've done for my business is also diversification. And I think that's what a lot of realtors have not been great at, because we've always preached like stay in your lane, whether it's geographic competency or, whether some people like to work with veterans or first-time home buyers or luxury only or, geographical tight-knit areas. I think those are the people that are kind of hurting more so, where they don't have offsetting, referrals and revenue streams. And I'm not saying everybody go out there and just try to be the jack of all trades. It's just that was something that I've constantly, and that's a benefit. I'm on Plug Metrotex. That is a benefit of being involved with the association. I have been exposed to people in other rooms that I wouldn't necessarily have been exposed to, that have contributed to my growth in different types of product types, relationships, referral partners, all of those things. And so when you tie it back to, I got to go make money, but why would I get involved in my realtor association? My business continues to grow. And I think we get really stagnant in our thought process of what business growth looks like. I get referrals for different product types that other people don't do, but they trust me, they know me, they like me, and they know their clients will be taken care of. And so I continue to expand your diversification. And right now, if you're not exponentially busy, and there's a lot of us that are still bringing in money but not as busy, go to the association. We've got tons of things going. We've had area realtor meetings where we're bringing in major affiliate partners, economists, different people to talk about global, commercial, property management, all of these things. Go on, the great Oz that's behind here. He can put our events calendar link on here. I think it's mymetrotex.com, probably /events or something else, and get to our calendar. But look on there, because right now where everybody's feeling a little bit uneasy and there's a sense of fear and a scarcity mindset, the best thing you can do is not stay isolated and to put yourself in a room with other people that are trying to engage. Look at that. See? And I was correct.
Wow, you did get it.
mymetrotech.com/events.
Yeah, no, there's going to be a culling of the herd, so to speak.
Yes.
And, that is literally a nature term. And the way that works is the herd ends up being stronger after the fact. It's, and so, I think that it's just not always pleasant. And, but you're right. The opportunities to improve ourselves and,
yes.
You just mentioned that, all these classes that y'all can take, title people or mortgage people or whatever, dealing with technologies and all the things that are out there that shoot, 2 years ago, none of us had time to even look into the new technologies.
Correct.
And, that kind of thing. So absolutely, we should all be working to better ourselves. And that's what I'll be preaching to my teammates is like, all right, hey, look, if it gets slow, let's all make sure we're caught up on our CE classes and not just like for credit, but like, let's get smarter, and absolutely agents, the same thing.
Well, and that's the thing, set the foundation for smart strategic growth when things do get busy again. And this is the people that will always prevail, that 1%. It's because when times get lean, they get mean. And by mean, I mean, they just grind out and they dig in. And so whether it's Metrotex, whether it's Fair Texas, which is a great partner that gives great educational opportunities and networking opportunities, or some of your other affiliate partners, this is what everybody should be doing, continuing to building relationships and growing. We just did a real talk on ChatGPT and AI, and that's something that's, really scary for some, but artificial intelligence has truly been here for a very long time. We just now have access to it, where before, other people were the gatekeepers of it. And so that was something where, it was a very basic level, but it was very tactical, and it was something that could be implemented. And I think 21 of the people that watched it actually signed up for just the training program. And it wasn't I don't think it was an expensive one. I think it was just more of teach me, and if we can get back to that, then we're going to be better equipped to grow our business, serve our clients. And when we're on the other side of enduring this lower period, we're going to prevail over everybody else.
Well, I think, what's interesting is, we were talking, there are some depressing trends in the United States as far as, our national debt and do people want to work hard and all these things that you sit here and we can argue over. But, the one thing that I can point to that might be sort of our saving grace, or at least this time, is that AI stuff, because the thing that ultimately gets an economy, sort of out of the ditch is improvement in efficiency and output, per employee, or whatever the right way of thinking is. And so if all of a sudden we all have this magic wand in our hand that is AI, and we can all do 10 times more, that frees up resources to go do a whole lot of new things. Again, just because we got rid of the buggy whip industry, well, that didn't mean it was like terrible for the economy. We had all of a sudden had cars and had trucks and had all these things, and so it's like, that's this improvement, and the AI stuff, it still blows my mind. But like, just thinking about the efficiency improvements that we can all have if we all have a virtual assistant on our shoulder at all times, who, we just say, hey, write the letter to Ashley Gentry and, give her the update on the file or whatever. And all of a sudden, poof, that just saved 30 minutes or whatever it is. And so that is like I said, it's scary, but it is also potentially a real game changer for our economy as a whole, and certainly for the people who embrace it.
Well, and I think that's the biggest thing, is that people keep on talking about feeling irrelevant, or they're going to be surpassed in their value proposition. Again, this is your time to kind of reconfigure what that looks like. And there were plenty of people. You've been in the industry for a very long time. I was raised in it myself, second generation. And I remember when there were MLS books, and you went and got a key out of a cabinet, and you had a forms library and sat there and put your forms in your trunk, and did all of those other things, and had a maps go. And look where we are now.
Yeah, it's better than that now.
It is better than that now. No, it is better than that. But if we resign ourselves to being, and we go back to the data portion of it, it's like, oh, we let go of all of our data. Well, if all you was a gatekeeper of the data, that wasn't a value proposition to your client. And if there are things that can now be automated that allow me to really dig in and be that real trusted resource of being able to navigate all of the nuances that we've been talking about today, and it frees me up from writing an arduous email or setting up a template or doing something else, then I'm better for it. But I think we automatically go to stinking thinking, and it's, oh my gosh, the machines are coming for us, and all of these other things. As we've had technological improvements, year over year and decade over decade since I've been alive and you've been alive. And so got to lean into some of it. I'm not saying abandon everything. All I know is that I get to be continuously more intentional with the technology that I have to outsource some of those menial tasks that don't help me. And I think that's everything.
Or it outsources the tasks that people don't want to do in many cases, right? I mean, so
thank you.
There are, the menial ones, in particular, but like keystroking and things like that. If you can do, the OCR, optical character recognition, all this stuff and, scans and, rather than rekeying stuff. I mean, that's just an obvious use of technology that nobody wants to be in that job where you're just retyping something that was already typed, like that's what.
How about this?
You get in that?
This is great. So one of my favorite things that is coming out, like, Britt, realtors don't like to read, most of them. Okay. I don't know if you know this about us, but we don't necessarily.
Okay.
Okay. And it's a joke, kind of sure. And there are plenty of people that do like to read. However, I love to learn. I just hate to read. And so I learned this, and Sherry can chime in, because I used to make her read my required reading to me because I would refuse to read it. Because to me, that was just de-energizing. Realizing
that's what YouTube is for, right? Now
I'm an auditory learner.
Okay.
And so, realizing that I found books on tape before they even had them, and that was something for me. I'll listen to it. I enjoy to learn information. We learn about our clients, but now we get to sit there and even input communication styles. And so it's like, here's the information, retool this for somebody that has a disc profile of a DI. You can literally be, and Sherry did read it as the characters talking about To Kill a Mockingbird, whatever.
I want to hear the voices. Did she do voices?
She did. She read the voices.
Okay.
Yeah,
yes.
No, it's really good. We can do that the next time we hang
out.
Good. But no, for that, you can literally retool it and say, here's the information, condense this now for somebody that it's not that I don't like to do that. It's just condense it into a format that I'm going to read and like, that it's not going to de-energize me. And so for our clients, for our partners, for everything else, like those are really interesting things that now allow us to be more intentional and really read in the audience that we're trying to do. And so for anybody that didn't get to watch our Chat GPT one, the recording's available. You can watch it. It's on the Metrotech's Facebook page, probably LinkedIn and YouTube as well. But it really we actually showed examples in real time how to kind of like continue to feed the right questions to deliver the right output. Mm-hmm. And the whole point is treat it like an employee. So if you're going to give somebody examples and you're going to give them instructions, that was part of it. He did a whole thing about chili and giving prompts about whether or not beans belong in chili. And it was hysterical.
They do not.
And it was marked.
Yes.
They do belong in chili. Yeah, no, they do belong in chili. But that was the whole thing. It was like, give me a marketing campaign for realtors to talk to native Texans about whether or not beans belong in chili. And it was so neat to get that. Oh, look, see, we even have it right there. So we've got the link in there. And I think it was tactical takeaways. And that's what we need to, and that's what this platform is for. And that's why we love having you on.
Back to that, like I said, we're in a housing slowdown right now. And so it's easy to sit here and go, oh, woe is me. I don't have a client meeting this morning. I think I'm just going to get on my social media and watch all the funny video, the reels or the TikToks or whatever. But yeah, I mean, there are some cool things that you can be doing to better yourself and come out in the end, stronger when this thing turns around and activity picks up. So.
Well, literally, Sherry puts in beans belong in chili. You said, no, they don't. We have somebody else. Bradley Edge, who's one of our fabulous board of directors, and as well as our government affairs chair, and he said beans do not belong in chili.
Hopefully there's nobody from Cincinnati where they put spaghetti in the chili. Yeah, exactly.
That's called SpaghettiOs. That's disgusting.
Well,
yeah, no. Yes. No, but Clinton, it is a rough time for commercial, and I think that is another topic for another day that we will be talking about absorption rates and office commercial and what's it doing to storage and other opportunities, because the debt service market on the commercial side is a whole nother gore.
Can I add something though? And this is not really to deal, because I think that is its own episode, but from the residential people who are watching this and thinking about this stuff, like when you're always thinking about who's my next client, like understand that the pain in commercial might make somebody less, like whoever your star clients have been over the last few years who've bought lake houses and bought whatever. Well, you know what? They may be interested in selling their lake house or whatever, that's understand. And I'm not picking on commercial real estate, but like it's an example of an industry that is early in this process of hitting a rough patch, right? And so there may be people who want to get more liquid and might actually be potential sellers who then help us with our log jam of not enough homes on the market. So anyway, that to me is one of those things that, oh, wait a minute, somebody, that opportunity everywhere. That's correct. Yes.
Yes, no, absolutely. No, and I think that's the biggest thing, is that we need to recalibrate our thought process. And I can tell you this morning, I was listening to one thing, it wasn't working. I have a friend that understands my thought process, and I called him. I was on the way to Metrotex, and I'm like, dude, I'm in a funk this morning. He's like, me too. And then he just started kindly yelling at me of what I needed to hear. And I was like, no, I need to sit there and recalibrate my thought process of how I'm feeling about this, because every lack of opportunity, there's a larger opportunity as far as just redirecting my energy. And so, this isn't working anymore. Then I have to figure out something else, because as Harmon said, if you're not in front of a buyer or seller, you are unemployed. Well, they might just change. Your buyers and sellers are changing. And I think that's what people are struggling with, is that their clients and what they look like are changing day to day. It might be out of desire. Now it's out of necessity, like you just said. And so we also need to change how we're coming to the table and dealing with those things. So we've got 3 minutes left, Britt. Is there anything that you kind of want to leave our audience with parting wise? Sans chili bean talk.
Yeah, sorry. Or nor spaghetti, by the way. Don't let the current slowdown define you. Don't let it drag you down and depress you. It can be depressing, but as you were talking about, I mean, there are so many things that you can be doing to be ready for when the activity levels pick up. Certainly there are deals out there, right? And whether you're an agent or a title company or a mortgage lender or whatever, like obviously there is still market share to be had. It's just, the overall number of transactions is down. But to me, like I said, there's this natural process. The business has been, at least from mid 2020 to mid 2022, it was too busy, too active, too easy in many cases. And we probably pulled forward some transactions that otherwise would have been occurring right now. And so, it's a cyclical business, and, you hunker down, you get lean, you get mean and efficient and smart and, improve yourself and all these, whether it's AI or any of the other types of classes. And, there will always be people buying and selling real estate here in North Texas. And there's more and more people moving here every year. And, it's a great place. It is the place to be in my mind, as far as real estate. And so, don't let it depress you and just keep plowing forward, because better times are ahead. We may have to have an economic recession before housing benefits from that.
Okay. So I'm going to use an analogy really quickly. For all of you that are in committed relationships or married, there's a difference between dating, the honeymoon period, and being a few years into your marriage. And you know what? If you dig in and you do the work, not every year is going to be the same as the previous or the next, but you got to dig in, guys. And that's the thing. Like, nothing worth doing is going to be easy. And if my husband's watching, I'm really sorry. But not every year has been perfect, you know, but you sit there and you say, you know what, when it's not, you do more work and you figure out what you need to do to improve the communication, to improve the relationship and stabilize everything.
Yeah.
You know?
Now, I again, there's no place that I'd rather be doing real estate than right here in the Dallas-Fort Worth area. So we're in a great place. You know, it is a worthwhile industry. It just, you know, like I said, it's a little tougher now than it was a year or two ago. And it will be better, you know, in a year. It's just right now it's endure and improve yourself.
Endure and improve. Don't get, you know, in that scarcity mindset and fear-based, guys. And so if you need to find good environments and good rooms for that type of, you know, mindset, make sure that you're getting with your other industry partners. Come to MetroTex. We've also got a beautiful new building with a members lounge and other opportunities. We've got mentor programs. We've got free MLS training programs. Britt's sitting there, right? Yeah. Yeah, it's all right.
Thanks, Sherry.
Yes. So guys, there are opportunities though to continue to put yourselves in the right rooms with the right people that will continue to be cheerleaders and provide great education. So reach out to myself, reach out to Britt. Him and his team have amazing opportunities to do that as well. And I think from all the thank yous going through, there were a lot of people that really enjoyed tonight's episode. So we will do this again, of course.
Well, hopefully I won't be so depressing next time.
You were not depressing. I think this was a great one. We were realistic and energetic at the same time. So, guys, endure, educate, and embrace change. So, Britt, enjoy the rest of your evening. And everyone on the chat, we look forward to seeing you again soon. So, good night.